Hello and welcome back to the Note. And I'm afraid it's been another very gloomy day on world markets. It all started with some bad news from China. Industrial companies' profits are down more than 8% year on year. Not exactly frontline data, but still enough to worry people. You saw further sell-offs in industrial metals, even if they didn't get to a new low. You saw a very dramatic sell-off in European markets, particularly of resources companies. And you saw a further sell-off in stocks here in the US. The S&P 500 now only needs to fall another 0.6% to take out its low for the year set in August. That was led primarily today by healthcare and pharmaceutical stocks. Now, let me try to put a little context on this. If we take a look at European resources groups, obviously and with good reason, Glencore has dominated the headlines. But in fact, it's more than just Glencore. This is a much broader story than that. The sector as a whole has fallen more than 60% since Glencore floated back in 2011. And Anglo-American, a big mining group, one of its prime competitors, as you can see, has fallen almost exactly in line with Glencore over almost all of that point. This is a generalized and arguably overdone sell-off of materials groups. There are plenty of reasons for concern. Whether we really at this point are justified in selling off to this extent is a question. Now, if we take a look at the problems for asset allocators, you can see this compares bonds and stocks. Stocks, we're looking at the S&P 500 total return index. It's down for the year, even including dividends. Bonds, and for this we're using the Bloomberg EFA index for treasuries of 10 years or more. Again, even on a total return basis, are down for the year so far. Gold, which you would normally regard as your safe haven against problems for bonds and stocks, is also down, and it's been a rotten year to try to guard against losses. The best asset class has been cash, and that really says something when cash is yielding you virtually zero. Finally, if we take a look at world stocks, one thing that's very intriguing, if we look at the last 2 years, it's no surprise that emerging markets have done as badly as they've done. They're down 20% now over those 2 years. But it's quite startling looking at the FTSE indices to see that the developed markets are also now actually down over the last 2 years. This is 2 wasted years for world markets. As I said, you certainly can argue that at this point this looks rather overdone given the news that we've actually had so far. China is still growing. It's certainly not in recession. There's no sign of a recession here in the US. But you could also argue that this kind of anxiety shows that there has been a lack of confidence about the valuation of the stock market, particularly in the US all along. They have been prone to this kind of a sell-off once confidence is shaken for a while. What will determine whether this turns out merely to be a buying opportunity, a correction, or whether it's the start of a broader bear market? Well, we have a lot more data later this week with unemployment data on Friday, obviously particularly important. But I suspect what really matters is the earnings data for the third quarter, which will come through in another 2 or 3 weeks' time. Both of the first 2 quarters of this year, we were braced for outright declines in earnings, and that didn't happen. We've seen write-downs in profit forecasts already for the third quarter. If this time those gloomy forecasts turn out to be true, then this sell-off could have further to go. Otherwise not.